Get ready for the breaking news that's shaking up your world. Netflix is absolutely dominating headlines with incredible earnings, smashing analyst expectations, and showing off a powerful return on equity. We're diving deep into the numbers that show just how strong this streaming giant is and what it means for you. Don't miss a second.
Never get caught with a dead phone again. This INIU portable charger is compact, travel-friendly, and gives you fast 45-watt charging with a built-in USB-C cable, so there's no need to carry extra cords. With 10,000 mAh power, it's perfect for busy days, trips, emergencies, or anytime your battery drops too low. Grab yours on Amazon through the link in the comments before your phone hits 1%.
But the big story doesn't stop there. We've got the inside scoop on Netflix's latest revenue surge, fueled by their booming ads business and smart pricing changes. Hear directly from co-CEO Ted Sarandos about their strategic wins and how they're building even more M&A muscle, including their bold move with Ben Affleck's AI startup. And the drama continues as Netflix announces a major shift. Co-founder Reed Hastings is stepping down from the board, but don't worry, he's just focusing on philanthropy. We've got all the details on his departure and what it means for the future of the company as they eye further growth in entertainment and technology. Plus, we're tracking the incredible rise of Oracle, driven by AI and massive power deals. And hold on to your hats as Oklo, the experimental nuclear reactor designer with White House ties, is on fire this week. Make sure you're subscribed and hit that notification bell so you don't miss any of these explosive stories. Netflix has reported a significant earnings beat, posting an earnings per share of $999, far exceeding the consensus estimate of 76 cents. The internet television giant also showcased a robust return on equity of 43.26% and a net margin of 24.3%. While Netflix shares saw a modest uptick of 17 cents to $107.88 during Thursday's trading session, trading volume was below its average. The company's stock currently holds a 12-month low of $75.01 and a high of $134.12, with a market capitalization of $455.49 billion. In other developments, Netflix CEO Gregory K. Peters and CFO Spencer Adam Newman have recently sold substantial portions of their company stock, totaling over $5 million. These insider transactions, along with a larger trend of insider selling over the past quarter, represent a notable decrease in direct ownership for both executives. Meanwhile, institutional investors are making significant plays in Netflix. State Street Corp., Morgan Stanley, Price T. Rowe Associates, Inc., MD, Bank of America Corp. DE, and Northern Trust Corp. all dramatically increased their positions in Netflix during the fourth quarter, signaling strong institutional confidence. Analysts remain largely optimistic, with a consensus rating of moderate buy. Several firms have recently adjusted their price targets and ratings, with Morgan Stanley raising its target to $115 and Goldman Sachs initiating a buy rating. Despite this positive outlook, an independent analysis from Channel YouTube suggests 5 other stocks might currently present better investment opportunities than Netflix. Netflix has delivered a powerful first-quarter earnings report, significantly exceeding Wall Street expectations. The streaming giant announced a first-quarter profit of $5.28 billion, translating to $1.23 per share. This performance handily beat the 76 cents per share anticipated by 10 analysts surveyed by Zacks Investment Research. Revenue also surged, reaching $12.25 billion for the quarter, surpassing the $12.17 billion forecast from 9 Zacks analysts. Looking ahead, Netflix projects second-quarter revenue to fall between $12.57 billion. The company has also set an optimistic full-year revenue outlook, forecasting between $50.7 billion and $51.7 billion. Netflix is defying growth concerns with a robust first quarter, reporting a 16% revenue surge to $12.3 billion. This impressive climb is attributed to a significant boost from its advertising business, strategic pricing adjustments, and a steady increase in subscribers. Profit soared by a remarkable 82% to $5.23 billion, or $1.23 per share. The streaming giant's financial health remains strong despite its recent withdrawal from the highly publicized $83 billion Warner Bros. Acquisition. While Netflix did not secure the deal, it did pocket a substantial $2.8 billion breakup fee, a move that contributed positively to its earnings. Co-CEO Ted Sarandos highlighted the exercise as a crucial learning experience, emphasizing the company's commitment to investment discipline and its willingness to walk away from deals when the cost outweighs the net value. Sarandos reassured analysts that the Warner Bros. Acquisition was a nice-to-have, not a need-to-have, and that Netflix is confident in its core business. He stressed that the company's primary risk was losing focus during the transaction, a challenge they successfully navigated as evidenced by their strong quarterly performance. Looking ahead, Netflix is focused on three key growth pillars: expanding its entertainment offerings, innovating its technology with advancements in generative AI and vertical video, and optimizing monetization through pricing and its burgeoning ad business. M&A will continue to be a strategic tool, but with a strictly disciplined approach. The recent acquisition of Ben Affolk's production startup, Interpositive, for up to $600 million, signals a move to enhance its generative AI capabilities for creative partners and improve content recommendations. Significant updates are on the horizon, including an updated mobile experience featuring a vertical video feed, set to launch at the end of the month. The company is also expanding its video podcast offerings and growing its Netflix Playground gaming app for kids. Complementing these initiatives, Netflix has implemented price increases across all U.S. plans, with monthly rates now ranging from $8.99 to $26.99, and additional member fees set at $7.99 for ad-supported and $9.99 for ad-free tiers. Co-CEO Greg Peters confirmed that these price hikes were anticipated within the company's 2026 financial guidance, reinforcing their commitment to delivering value. He pointed out that Netflix subscribers currently pay the least per hour of viewing compared to other subscription video-on-demand services, highlighting the competitive value of their ad-supported tier. In leadership news, Executive Chairman and co-founder Reed Hastings will be stepping down from the board following the company's annual meeting in June. Sarandos clarified that Hastings' departure is unrelated to the Warner Bros. Deal. The ad business continues to be a major success, with Netflix on track to generate $3 billion in ad revenue this year. The ad tier accounted for over 60% of new signups in countries where it's available, and the company is now working with over 4,000 advertisers, a 70% year-over-year increase. Netflix is maintaining its full-year revenue guidance of $50.7 billion to $51.7 billion, and an operating margin of 31.5% for 2026. For the second quarter, the company forecasts revenue growth of 14% to $12.6 billion and a profit of $3.3 billion, or 78 cents per share. Netflix reported stronger-than-expected Q1 revenue, exceeding Wall Street's expectations with $12.25 billion, despite a significant $2.8 billion termination fee from its withdrawal from the Warner Bros. Bidding war. However, the streaming giant's Q2 earnings guidance fell short of analyst consensus, projecting 78 cents per share against an expected 84 cents, causing its shares to dip 9% in after-hours trading. This marks Netflix's first earnings report since it opted out of the Warner Bros. Discovery deal in February, a move largely seen as positive by the market, with its stock up over 25% since. Co-founder Reed Hastings is also stepping down from the board in June to pursue other ventures. Meanwhile, Oracle saw a significant surge, up nearly 27% for the week, driven by AI-related sales and strategic partnerships, including a new collaboration with Amazon Web Services. The energy sector also saw activity, with Oklo, a designer of experimental nuclear reactors, experiencing a strong week, potentially benefiting from a White House directive for deploying nuclear reactors in space and on the moon. Quantum computing stocks like D-Wave Quantum and IonQ saw substantial gains following NVIDIA's release of OpenAI models aimed at improving quantum computer calibration and error correction. In the airline industry, Frontier and JetBlue stocks rose as rival Spirit Airlines reportedly faces liquidation, a development influenced by ongoing struggles with jet fuel prices and past failed merger attempts.